Happy summer from the Schaefer Financial Group. We hope you all are enjoying the summer of 2025. It certainly has been a hot and muggy one, but a great summer so far. Hope you've had time to get near the water, in the pool, enjoy time with family, friends, and had those outdoor barbecues. As we get into the dog days of summer, sometimes things slow down a little bit, and that's good for and healthy for everyone. We just thought we'd take a quick minute, update everybody on the numbers so far at the midpoint of the year. So I'm just going to take a second here, share my screen with you all. And let's have a look here. So as we're going through the year, it certainly has been a wild one so far, but the numbers are off to a good start. So far, when we look at the TSX, the Canadian market, it's had a good year to date at the halfway point. As of July 1st, the TSX is up 8.61%. The S&P 500 up just 5.5%. NASDAQ up 4.5%. And we look through the rest of the world, China up 3%. Germany's the big winner, up 18, 19%. Italy's up 15%. UK's up about 7.5%, Australia just under 5%, and India just under 7%. The interesting thing, even though the US market has produced some mid-single digit returns year to date, the Canadian dollar has also appreciated against the US dollar just over 5%. So unfortunately for Canadian investors, our US returns are relatively muted, with the US market generating kind of 5.3%. and the Canadian dollar tightening by 5.3%, it's actually flat for us as Canadian investors in terms of Canadian dollars. But what has happened in the US from earlier this year is quite remarkable. From being down 18% to a new one-year high, all within 3 months. So we took a little step back and kind of looked in the past when we've had these types of rallies, which has happened in 33, 35, 88, 98, 2003, and again 2009. So it's kind of been 15 years or so since this happened. But the interesting thing is it has led to strong markets. When we look 1 year later from that event happening, it has produced on average a 21% return and has been a positive 100% of the time. So this big strong recovery and moving to new highs is actually a bullish indicator if we use history as a guide. Also, what's kind of going in our favor, July is the current month that we're in has been on a hot streak. And as you see here, has been positive each year for the last 10 years. And let's hope that streak stays alive. Again, I mentioned we're at all-time highs in the US market, and that can often lead to a little bit of nervousness for some people, but the data shows otherwise. And what this chart shows you is an interesting phenomenon: investing on any given day or waiting to invest your money at a new all-time high. As you can see, that by investing when the market makes a new all-time high can be quite profitable. You know, you look over the last 5 years, investing on any given day has produced a 74% rate of return versus 81% for investing at a new high. So we really want to kind of emphasize that. If you think about, getting nervous at new all-time highs, we really should be excited. When you look at a long-term chart of the market, it often starts in the bottom left-hand corner and rises to the top right-hand corner. And so that is the market consistently making new highs, and that should be a bullish indicator for the market as a whole. We are in a bull market, year 3 of the bull market. And as you can see with the green line here, compared to other bull markets, we're still in the early stages. This bull market started in October of 2022. So from October of 22 to October of 23, the first year's returns in that bull market was less than what they normally were for year 1. However, year 2, which was October of 23 to October of 24, they were better than what they normally are in the second year of a bull market. Interesting enough, when you add the two together, they're exactly where it would be, at the end of the second year of the bull market. We're in year 3 of the bull market. Year 3 is the crummy year, the stressful year. Year three is where not much happens. You have everything from, a mild gain to a mild loss. It tends to be volatile ride to nowhere. This year is shaping up to be exactly what is typical of a year three in the bull market. The average bull market kind of lasts kind of 4.5 to 5 years, so there's lots of legs left. Year four will be starting obviously in October of 2025. And we're seeing a little shift in terms of asset class. As you can see, in terms of the top returns in 2023 and 2024, it was large cap. US equities were the dominant. Now we've got developed market equities, followed by emerging markets, followed by high yield, and the large cap US is further down the list. All positive this year, with the exception of small cap has been lagging, REITs a little bit behind. Again, looking at, as you know, we are big fans of global investing outside of Canada and the US. And the US has been the dominant performer. So from the financial or the tech wreck, as they say, back in 2000 until the financial crisis, this is a period of time where international stocks outperform the US. As you can see, we've gone through a very extended period of time here where the US markets have outperformed the international markets quite considerably. That has been the longest cycle of US outperformance in history. The international markets tend to do better in a period of declining US dollars. This chart is on a 3-year rolling average. If we were to make it annual, you would start to see outperformance by international securities here. And obviously, there's lots of talk with the big, beautiful bill. This is the challenge that the US is facing, is when you look at their total spending, budget is $7 trillion a year. They're now up to almost $8 trillion in interest. They generate 2.6 billion in taxes, payroll taxes, almost 1.8 billion, some corporate taxes, but they are shy 27%, almost 1.9 trillion dollars. So that is a significant shortfall that the US government and, quite frankly, the Canadian government and many governments around the world are wrestling with, is the current size of deficits. Tariffs are obviously a big talking point. This chart goes back roughly 125 years. It shows, in the early 1900s, it was not uncommon to have tariffs in the 25 to 30% tax rate, spiked again in the Great Depression, which a lot of research has gone into that being a somewhat failed experiment. But taxes are definitely on the forefront. You can see that for most of the last 50 years or so, and beyond, quite frankly, that they have been somewhat declining. But here is, what the new tariffs rate would be, 30% on imports, 15% at this level. So that shows you a very significant change in tariff policy for the US. And in closing, it was the birthday of the Dow, which was happened in the second quarter of this year, May 26th, 1896 is when that index started. We're not big followers of the Dow, as it just has 30 stocks in it, but it is a widely followed index. It does have a remarkably long history. And when you look at this chart, you can see that the market continued to move higher over an extended period of time, and done exceptionally well, even with all the different reasons the market, maybe had a hiccup, a pullback, but overcame all of those issues over that period of time, and the markets continue to do so. In closing, just wishing you the very best that the summer has to offer. We are here and available to chat at any point in time. Should you have any questions, please feel free to reach out to us. Thank you very much. Take care. Enjoy.